This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Relevant costing. But as you'll see, there are really three separate techniques involved, which are to an extent related. But I will deal with each of the three separately. And essentially what we're talking about is making decisions. The sort of decision I'm referring to, suppose a customer has offered you a special contract. I've often talked about making desks, but suppose we're a desk manufacturer, but we've had a customer ask us to make some special desks as a one-off exercise. And we're deciding whether it's worth doing this or not. Well, surely we need to compare what would be the costs of producing the desks as against what revenue we're going to earn from the contract. That's essentially what we're after. In paper P1, we're interested really in short-term decisions. Perhaps this is just a contract which take us a few months to produce the desks. You'll see when we come to paper P2, we can also apply it to long-term decisions where we take into account the cost of money, but we're not concerned about that for P1. So essentially it's that, again, we're going to make these desks, we need to know how much this one-off contract is going to cost us. And you'll see in section 2, it says that what we're interested in is the future incremental cash costs. Now it may seem fairly obvious, incremental extra. What we're concerned with is what extra cash costs will there be if we go ahead and do the contract. It says an exception to this is opportunity costs. I'll explain briefly, but it's going to be more obvious, I think, when we come to look at an example where you can see precisely what I mean. But the point is, during the contract, obviously we'll have some direct cash costs. We'll have to buy wood to make the desks. But there could be other, what we call opportunity costs, in that maybe in order to make the desks, we're going to have to transfer some workers that are currently doing other things. Perhaps we can't get any more workers. So we're going to have to transfer workers from some existing work. And if they don't do the existing work, we're going to lose money there. What they're currently doing is earning as a contribution. If we move them to do this new contract, then maybe we lose contribution we could have earned. That effectively becomes a cost of the work on the contract. However, that will become hopefully much clearer when we look at an example. Otherwise, we are interested in what future extra costs there'll be of doing the work. You'll see in section 3 various non-relevant costs, costs that may be mentioned but aren't going to be relevant to the decision. And the first one, it's very much a terminology thing, but sunk costs. Sunk costs is money that's already been spent. Maybe we've already been spent some money designing these new desks, what they're going to look like. Well, that money's been spent, whether we go ahead with the contract or whether we don't. That money's lost. And so to decide whether to go ahead with the contract or not, we're only concerned with any future costs that there are going to be. So I'm not going to write down what's on the page, but some costs, it's money we've already spent and it's just not relevant to the decision. Shall we spend more money in order to get the contract? Now, committed costs, they're costs which are going to be spent whether we go ahead or we don't. So, for instance, we may be paying rent on our factory. Remember, we're already producing desks. This contract is for a special extra a set of desks. Well, if we're paying the rent anyway, and if the same rent's going to be paid, whether we do the contract or we don't do it, then it's not relevant to the decision we're having to make. Something else that's often mentioned in questions, book values or historic costs. Book values, the values of things in the statement of financial position, the balance sheet, or what we originally paid for things, is usually irrelevant. Book values are sort of genuine, what you might call values of assets. And historic costs, I mean, if you've already paid money, a bit like a sunk cost. And finally, non-monetary costs. I said on the previous page, we're interested in looking to see what future extra cash costs will be. So things like depreciation, amortization, they're not cash costs. We're not really interested in them. In a minute we'll do a full exercise where you'll see examples of all of these things, and hopefully it'll make complete sense. But a very quick exercise first. Look at exercise 1. Identify the relevant costs from the scenarios below. Number 1, your research team have spent 50,000 researching project Q during 2x14. Is that relevant or not relevant? Well, it's not relevant. We've already spent 50,000, and whether we go ahead with our project, our contract, or whether we don't, that 50,000 has still been spent. What we're interested in, is it worth spending more money? It's worth spending more money if the reward at the end is greater than what we're having to spend. Number 2, the production manager currently earns a salary of 20,000 a year. Our new project or our contract would incur approximately 5,000 a year of overtime, which will mean his salary will be 25,000 for the duration of the project. What's the relevant cost? Well, assuming the project takes a year, she doesn't say here, but still, assuming it takes a year, we're already paying him 20,000 with or without the contract. If we do the project, it'll go up to 25, so there'll be an extra 5,000 payable. Well, it's the extra cost of doing the work that we're concerned with, and so the relevant cost would be the extra 5,000. Finally, 3, a decision to manufacture a new product is expected to increase fixed costs by 3,000 a month. Is that relevant or not? Well, yes, it is. You know, if fixed costs were to stay unchanged, earlier I mentioned rent of the factory, if it was going to stay unchanged, we're not interested. We only want extra costs of doing the work. But here, if our fixed costs, if for some reason our rent or whatever it is was going to go up by 3,000 a month, well, that is relevant. That is an extra cost. All right, now let's actually do a full example. Exercise 2 over the page. It's quite a long example, although hopefully it won't take too long. But within it are examples of all the different little bits of problems that could occur. And it does say, before the exercise, I'll say it here, one thing about relevant costing is, unlike most of the other topics, it's not something where you can really learn rules. You know, for things like variances, although you must understand them, you can learn the rule and hopefully get the variance correct. With relevant costing, it's not so much rules. If you're happy with the basic idea that we're looking to see what extra costs there will be in the future of doing the work, then the problem is much more reading carefully than actually learning any rules. So let's have a look at it. Have a quick read with me. I'm not to read every word because I'll also go through it slowly. But the managing director of Parser, a small business, is considering undertaking a one-off contract and has asked her inexperienced accountant to advise on what costs are likely to be incurred so that she can price at a profit. So it's a one-off contract, we're not going to keep repeating it. And of course, to decide on what price to charge, we need to know what the cost's going to be if we're going to be profitable. And the following schedule's been prepared. Wages, supervisor costs, general overheads, depreciation overheads, materials. There's a total there of 98,300. And of course, if that is the cost of doing the work, fine. We'd need to make sure we charged more than 98,300. However, it's been prepared by her inexperienced accountant, which rather suggests from the wording that perhaps there are some mistakes. And you'll see if you look to the very end of the question or on the next page, it says, adjust the schedule prepared by the accountant to a relevant cost basis, incorporating relevant opportunity costs. What I'm going to do, you see there are notes against each of the costs of the schedule. Direct wages, note 1, there's a note there which shortly we'll read. When we've read the notes, what we're going to do is rewrite the schedule using the correct costs, the relevant costs, which may end up being the same as the accountants produced. It may be different. But that's what we're going to do. We're going to prepare the schedule. What is the correct figure to include for wages, for supervisor, etc. So one by one, let's go through those notes and deal with them. So off we go. First of all, wages. Let's read note 1. It says direct wages comprise the wages of 2 employees particularly skilled in the labour process for this job, who could be transferred from another department to undertake work on the special order. They're fully occupied in their usual department, and subcontracting staff would have to be brought in to undertake the work they left behind. Subcontracting costs will be 32,000 for the period of the work. Different subcontractors who are skilled in the special order techniques are available to work on the special order, and their costs would be 31,300. So there's quite a lot to read there, but let's work it through step by step. In the schedule is 28,500, and that's the wages of these 2 employees who could be transferred from another department. Well, that's surely not relevant, because we're going to be paying those 2 employees whatever happens. If we do the work, fine, we'll still be paying them 28,500. If we don't do the work, they're doing their normal work, and they'll still be paid 28,500. So whatever happens, we'll be paying them their wages. And so the 28,500 itself is of no relevance. But if we do the contract, there will be extra costs because of subcontractors. But there's going to be a choice. The extra cost is going to be either if we use the existing employees for the contract, then we'd have to use subcontracting staff to do their current work, and we'd have to pay 32,000. So that's how much we'd pay if we used our existing workers. On the other hand, we could leave the existing workers where they are and get different subcontractors who are skilled in the special order techniques. So we've got 2 choices. Either move our workers, and then we have to pay subcontractors 32,000 to do the existing work, or leave the workers where they are and get special subcontractors for the new work. It's under 32,000 and 31,300. Well, if ever we've got a choice like this, we always assume we choose the cheapest. And so, in fact, what we do We'll leave our existing workers where they are. We'll employ these special skilled subcontractors, and effectively, therefore, the extra cost we'll have is 31,300. So that's the figure that should be on the schedule. Again, the 28,500 is completely irrelevant. Whatever happens, they're still getting paid. It's what extra cost of doing the contract is what matters. And it's these subcontractors at 31,300. Okay, let's look at the next one. On her list, she's put Supervisor Costs. There's 11,500 there, but let's read note 2 and see if that figure is the correct figure or not. A supervisor would have to work on the special order. The cost of 11,500 is comprised of 8,000 normal payments plus 3,500 additional bonus for working on the special order. Normal payments is the fixed salary of the supervisor. So we're paying the supervisor a fixed salary of 8,000. And in fact, it says fixed salary. They'll be paid 8,000 whether they do some work on this contract or they don't. It's an existing supervisor supervising our existing work. Okay, give them a bit more work, they're still paid 8,000. So the 8,000 is not relevant. Certainly what is relevant though is we'll be paying a 3,500 additional bonus for working on the special order. So although in a minute there's a bit more to read, if for working on the order they're being paid extra, well, there is an extra cost of 3,500, the bonus. Remember, we want the future extra costs of doing this work. However, there is a bit more. It then says, in addition, the supervisor would lose incentive payments in his normal work amounting to 2,500. Now again, I think any problem is in the reading rather than the doing. What that suggests is that at the moment, he's getting incentive, effectively a bonus. At the moment, we are paying him a bonus of 2,500. If we get him to work on this special contract, he will no longer get that bonus of 2.5. He'll get 3.5, but he won't get the 2,500. So we're saving 2,500 on one hand, paying him instead 3,500 on the other. So in fact, the extra cost to us of doing the work is the extra 1,000 of bonus that we're having to pay him. There is one more line there, better check. It is not anticipated that any replacement costs relating to the supervisor's work and other jobs would arise. So no problem there. You know, a bit like the workers we were discussing before. If we did have to get somebody else in to do his existing work, then we'd have extra costs as well. But here it says no. So there we are. We were paying him 8,000 anyway. That doesn't change, irrelevant. But there is that extra bonus of 1,000. Next one, general overheads. General overheads comprise an apportionment of 3,000 plus an estimate of 1,000 incremental overheads. Well, first of all, this apportionment, what does that mean? You see, we've got lots and lots of work going on. This is just one extra contract we're considering. And we may have lots of factory overheads, rent and whatever else, maybe in total 50,000. Well, for profit purposes, if we're preparing profit statements, we could share that 50,000 overheads between our jobs any way we want. But what we're concerned about is, will we actually have to spend any more in order to do this contract? And even though we might change the way we share or apportion our current overheads between jobs, sharing them differently doesn't actually mean we're spending any more. So if ever you see an apportionment of overheads, that's not relevant. It simply means we're sharing them differently. It doesn't mean we're actually spending more. So 3,000 is of no relevance. But it says there's an estimate of 1,000 incremental overheads. Again, incremental means extra. And so specifically, if we are having to spend more, it is relevant. So all that's relevant is that 1,000 incremental overheads. Next one, depreciation. Depreciation, machine depreciation, represents the normal period cost based on the duration of the contract. Let's stop there for a minute. The normal period cost. Surely when we depreciate, the various ways we can calculate depreciation, but you've got depreciation for the year, for the month, however long the contract takes. But surely there's no mention here that we're having to buy a new machine or anything, so we'll be depreciating anyway. And just as important, depreciation isn't actually spending money. There's no cash cost as a result. So depreciation itself is never going to be relevant. We're only concerned if we're actually spending more cash. It does say, though, in the same note, that it's expected that 500 will be incurred in additional machine maintenance costs. Of course, the original schedule, they brought in depreciation that shouldn't be there. But if we have got extra costs involved, this extra machine maintenance, then that certainly is relevant. How much is it? 500. There is an extra cost. Okay, so far I hope so good. I hope you'd agree with what I said before, that the problem, insofar as there's any problem, is more the reading. Especially in a hurry, it's obviously easy to misinterpret. But otherwise, I hope it is clear enough. However, look at number 5. Machine overheads for running costs such as electricity are charged at $3 per hour, and it's estimated that 6,000 hours will be needed for the special order. And so you can see where the figures come from on the schedule. The accountant simply said 6,000 hours of electricity, $3 an hour. Fine. There's 18,000. The machine has 4,000 hours of available capacity. Remember, we need 6,000, so it's 4,000 hours available. The further 2,000 hours will mean an existing job is taken off the machine, resulting in a loss contribution of $2 an hour. So let's think this through. First of all, if we forget just for a second this limit on capacity, suppose that we did have 6,000 hours available spare time, then it'd be easy. The machine overheads, such as electricity, would simply be the 6,000 hours at, what was it, $3 an hour. The schedule would have been correct, 18,000. So if you've got plenty of spare time and we're just using the machine an extra 6,000 hours, then fine, an extra 18,000. However, although we are going to run it for 6,000 hours, it turns out that 2,000 of those hours will mean losing some existing work. It says we've only got 4,000 hours spare. The other 2,000 will have to stop an existing job on which we would have been earning $2 an hour. And so we're going to lose some contribution. Currently we're earning $2 an hour. Well, for every hour we take for this contract, we're going to lose $2, therefore this contract has to earn $2 to make it worthwhile. And so we need to bring in this lost contribution. It's 2,000 hours which will be taken off another job, which is currently earning us $2. It's earning us 4,000. And so, although this isn't a direct cost, we're not actually paying out cash of 4. I say again, if doing this work is going to actually lose us 4,000, this work is, forgetting everything else, it's going to have to earn us at least 4,000 to make it worthwhile. And this is an example of what I mentioned quickly earlier, an opportunity cost. Where again, you're not directly spending money, but it is costing us because it's lost income. And so the total cost effectively for these machine overheads is 22,000. Nearly there. What's left? Materials. And this is note 6, which is over the page. Materials represent the purchase cost of 7,500 kilos bought some time ago. So on the schedule, there's 34,000. That's the cost. Presumably we're using 7,500 kilos, but that's the cost. The original cost of those 7,500 that were bought some time ago. Well, fine. So we spent 34,000 some time ago. But whether we go ahead with the contract or we don't go ahead with the contract, we've spent that 34,000 anyway. That alone is completely irrelevant. It's a sunk cost. The materials are no longer used and unlikely to be wanted in the future, except on the special order. The complete inventory of the materials, we haven't had 10,000, or part thereof, could be sold for $4.20. The replacement cost of the material we use will be $33,375. So what's happening? We've got plenty of material in inventory. It's already sitting there. We've already paid for it. And we're thinking of taking the 7,500 kilos we need from inventory, which in a sense is free. We're not actually spending any money because it's already there. The last line said the cost of replacing it would be 33,000, but that's surely irrelevant because it tells us the material is no longer used. And so there's no way we would then replace the material when we take it for the contract. That would be pointless. So again, we've already got the material. In that sense, it's free. We just take it off the shelf. But what would we do with this material if we didn't do the contract? It says it's no longer used. And it says we could sell the material for $4.20 a kilo. So that's the critical one. If we don't do the contract, presumably we'll sell it at $4.20 and get some money. If we do the contract, we'll lose the $4.20 we could have got. And so here we have another example of an opportunity cost. There's no direct cost of the material. We're not having to buy any specially. But if we could have earned £4.20 a kilo, then to make this contract worthwhile, we've got to get from the contract at least £4.20 a kilo. And so the cost would be the lost sale proceeds. It's 7,500 kilos we actually need. And we could have sold it for $4.20. So using it in the contract is losing us a total of 31,500 that we could have earned. Questions dealing with materials are actually quite common, and I hope that is clear. Because there's no other use for the material, the cost is the lost revenue we could have earned from selling it. If, on the other hand, this material was in regular use, in our other work, then if we, what you might call, steal some of it for the contract, then we would have had to replace it. So I will actually write down, because I said that too quick, if, which is not the case here, but if it had been in regular use, then again, using material, taking it away for this contract, is going to lose material for other work. Unless we replaced it, we'd use the replacement cost which would have been 33,375. So not relevant here, but I wrote that because it's slightly changing wording, it would be relevant. Alright, we've dealt with everything on the schedule, but there's a bit more. What does it say? Because the business does not have adequate funds to finance a special order, a bank overdraft amounting to 20,000 would be required for the project duration of 3 months, and we'd repay it at the end of the period. Why should that be relevant? Don't misread it. It's not saying that we're going to have to spend 20,000 doing the work. It's saying that just for the period of the work, for whatever reason, we're going to need to borrow 20,000. So we'll borrow it today and pay it back at the end. So the 20,000 itself isn't actually costing us anything, except it does say the bank's overdraft rate is 18%. So if we are having to borrow money for 3 months because of doing the contract, we are going to end up paying some interest that we otherwise wouldn't have to pay. So we do have an extra cost which wasn't on the original schedule. We're borrowing for 3 months. It's 18%. Actually, it doesn't say, but in the exam it would, and I will assume it's 18% a year. So it's 3/12 for 3 months of 18% of the amount borrowed, which is what, 20,000? And so this extra interest payable, I think, is 900. And there we are. I think we've listed everything there. They're all the correct future extra costs of doing the contract. And so, what's the total relevant cost? 31,3, 32, 33,3, 33,8, 55,8, 87,3, 80. I hope I've added up right. 88,200. There is the total relevant cost. And why is that important? Well, if there was already a price being quoted for the contract, then provided it's more than 88,200, happy to go ahead. If it's less, we're not. More likely, if we're negotiating for the contract, then although clearly we'll quote as high a price as we can, but given that the customer's likely to argue 88,200, we've got to make sure we end up fixing a price higher than that for it to be worthwhile. If it's lower, we'd be losing money. We said right from the beginning, this is only for a one-off contract. If this was going to be regular work, we'd cost out in a more normal way. But this is a pure one-off, 3 months' work. Doing the work is going to cost us 88,200 more than our current costs. Fine, we need to earn from it more than 88,200. Okay, well, I said there were 3 different techniques dealt with in this chapter. This is the most important one, relevant costing. And I do hope that's clear. You've got examples there of most of the different problems that can be posed. But as I said, it's very hard. There aren't many rules you can actually learn. If you understand the logic and what we're after, then again, it's more a question of careful reading. That more than anything is the problem, especially, I've said before, is when you're rushing, it's very, very easy to misread and misinterpret, even when you are clear what it is you're trying to do. Anyway, we'll leave that there. We'll have a break and then come back and do the second type of problem that's mentioned in this chapter.